On the morning of December 9th, 2025, something happened that was never supposed to happen. Silver didn't rise. It didn't spike. It broke. It shattered the barrier that had held for more than 40 years. $50, $55, $58, and then, without hesitation, $59. For decades, analysts told the American public that silver was a sleepy commodity, too industrial to soar, too manipulated to fall. But on that morning, every assumption collapsed in real time. Screens lit up across New York. Trading floors froze. Algorithms halted. Risk desks stared at their monitors, waiting for the price to snap back, waiting for gravity to return. But the chart didn't come back down. It kept climbing, as if the entire market had discovered something no one had reported yet. On CNBC, a panel of financial experts attempted to explain it. One said it was a short squeeze. Another claimed it was speculative momentum. A third insisted that silver was overheating. But behind the cameras, the truth was obvious. They didn't know what they were looking at. Because what was unfolding wasn't a rally, it was a revelation. For the first time in a generation, the world was seeing price discovery, a real price. Not the price produced by futures contracts or leveraged bets, but the price you get when a market finally admits what it has been hiding. And outside of Wall Street, the shock spread even faster. Solar manufacturers scrambled to call suppliers. Electronics firms placed emergency orders. Miners from Nevada to Mexico began receiving emails at 3 a.m., asking one urgent question: how much physical metal do you have left? No one used the word shortage. Not yet. But everyone could feel the tension tightening, the way air feels before a storm breaks. Because price discovery is not just a number, it is a message. And this message was loud. The world was running out of something essential. Traders felt it first. Industries felt it second. Even governments, quietly monitoring the spike, understood what it could mean. But the public only saw the headline. Silver surges past $59. What they didn't see, what almost nobody saw, was the shadow beneath the chart. A shadow created by something missing. Something that had been disappearing slowly, quietly, for years. And on December 9th, 2025, it finally hit zero. But the real story isn't the price move. It's the thing that vanished to make it possible. To understand why silver broke its 40-year ceiling, we have to investigate a disappearance. Not the disappearance of money, not the disappearance of traders, or miners, or regulations, but the disappearance of silver itself. Because somewhere between January 2021 and December 2025, the world lost track of 1.1 billion ounces of physical metal, not on paper, not in futures, not in algorithmic trades, but in the real world, the physical market that powers electronics, solar panels, electric vehicles, and missile systems. This is where our story becomes a mystery. When analysts reviewed the 2025 numbers, something didn't fit. Global mine supply had barely moved, stuck around the same 800 to 830 million ounces a year. Recycling ticked up only slightly. There was no major new source of metal. Nothing in the charts explained why prices were behaving like gravity had been turned off. But when you combine the mining reports, the industrial demand numbers, and the vault data from London and New York, a different picture emerges. A picture that looks less like a market and more like an autopsy. And the cause of death is written clearly. Structural deficit. The world didn't produce enough silver. Not in 2021, not in 2022, not in 2023, not in 2024, and certainly not in 2025. The deficits kept stacking year after year. 2021, a small shortfall. 2022, a giant gap over 230 million ounces. 2023, another major deficit. 2024, widening again. 2025, early estimates, another 200 million ounce hole. By the time the numbers were totaled, the world had consumed more silver than it mined for 5 straight years. And yet, nobody panicked. Investors shrugged. Banks acted normal. Media barely mentioned it. Why? Because the numbers were buried, hidden in annual reports, footnoted in obscure industry documents, wrapped in technical language designed to make the crisis look like a rounding error instead of a structural collapse. Even the Silver Institute, which reported the deficits clearly, phrased them gently: market tightness, reduced inventories, strong industrial offtake. But no one connected the dots. No one said, if we keep doing this, we will run out. And that's exactly what happened. The demand wasn't slowing, it was accelerating. Solar manufacturers needed more silver than ever. Battery producers were scaling. Electronics firms in India and China were expanding output. Defense contractors increased their orders. Meanwhile, miners couldn't dig fast enough. New mines were delayed for years. Old mines were declining. Environmental approvals slowed everything down. For the first time since the late 1970s, demand didn't just meet supply, it overwhelmed it. Yet, the market stayed calm. Silver stayed low. Prices barely moved. And here's the strange part. During this entire period of deficits, London vaults still showed ample supply, which makes no sense. If the world is burning through more silver than it mines, inventories should collapse instantly. But they didn't. Not at first. Because something unusual was happening, something hidden beneath the surface. A quiet bleeding of old stockpiles. Legacy metal, government holdings, institutional reserves. The kind of silver that doesn't show up in mining charts, but fills the gaps when production falls short. Analysts call it non-transparent inventory. Wall Street calls it float. But inside the industry, there's a more accurate name. A name whispered for decades. Ghost silver. Silver that shouldn't exist. Silver that isn't reported. Silver that kept the illusion alive. Once you see it, the mystery becomes clear. The deficits were real. The consumption was real. And the 1.1 billion ounces that vanished did not evaporate. They were drained from a hidden reservoir the public never knew about. And in 2025, that reservoir finally ran dry. The deficit was only possible because of one thing: ghost stockpiles. To understand the silver market, you must understand its greatest illusion, not the illusion of price, not the illusion of supply and demand, but the illusion of abundance. For more than 4 decades, the world believed silver was plentiful, cheap, available, replaceable, and the reason people believed it was because of a pool of metal that almost no one ever talked about. A pool hidden behind the headlines, hidden behind the futures markets, hidden behind the quarterly statements of the world's biggest banks. It was called the ghost inventory, not officially. No regulator used that term. No financial report printed it. But inside the commodity world, inside the back rooms where bullion banks, refiners, and institutions negotiated, everyone knew what it meant. Ghost inventory was the silver that wasn't supposed to matter. Old government stockpiles from the Cold War era. Bars sitting in London vaults since the 1992. Legacy reserves accumulated when silver was considered an industrial metal with no future. They weren't counted in annual supply numbers. They weren't counted in production forecasts. They weren't counted in demand projections. But they were there like a shadow market. And for 20, 30, almost 40 years, whenever the world used more silver than it mined, that shadow stepped in. Not openly, not loudly, but quietly, metal flowing from deep storage into the commercial system, 1 bar at a time. A solar manufacturer needed more metal, a bullion bank would source it. An electronics supplier needed a sudden shipment, a vault in London would release it. A deficit appeared in the global balance sheet, an old stockpile would smooth it out. It was the safety valve no one discussed. A silent buffer that absorbed shocks and kept prices low. A reservoir big enough to convince the world that silver shortages didn't exist. And for decades, it worked. Whenever demand rose, ghost inventory filled the gap. Whenever prices threatened to break upward, ghost inventory cooled the market. Whenever bankers needed to defend price ceilings, ghost inventory gave them the ammunition. It was the invisible hand beneath the chart, the reason silver stayed cheap, even as the world used more of it every year. But there was a problem with this illusion. Ghost inventory was not infinite. It was not self-replenishing. It was a finite inheritance from a world that no longer existed. A world before solar farms, before smartphones, before electric vehicles, before AI servers. And beginning in 2021, that inheritance started to bleed. Not slowly, not modestly, but at a pace that shocked even insiders. Vaults in London began reporting quiet outflows. The LBMA float shrank month after month. Bars that had sat untouched for 20 or 30 years were suddenly being moved, reclassified, shipped, melted, recast. The world didn't notice, not at first, because the data was vague, intentionally vague. Monthly reports used phrases like custodial shifts, inventory rebalancing, off-market movement, But behind those vague words was a simple truth. The ghost inventory was being consumed. Every deficit year drained it further. Every solar expansion drained it faster. Every investment wave accelerated the decline. By mid-2024, the trend was undeniable. Vaults were not just declining, they were collapsing. Bar counts dropped into territory the market had never seen. The registered metal available for leasing approached historic lows. A few insiders sounded the alarm, but publicly, silence. Because admitting the truth would trigger panic. It would force every industrial buyer, every metals ETF, every wholesaler to confront the same terrifying question. What happens when the hidden supply runs out? And then, in late 2025, it did. The buffer hit zero. No more legacy bars. No more Cold War stockpiles. No more hidden reserves coming to the rescue. The ghost inventory, the silent power keeping silver cheap, was gone. And the moment it vanished, the market changed character. Not gradually, not politely, but violently, because when a market that has been artificially supported for decades suddenly loses its support, you don't get volatility. You get revelation. And once that buffer reached zero, everything changed. To understand how silver stayed cheap for 40 years, you have to understand the empire that controlled its price. Not a government, not a mining cartel, but a paper machine, a financial architecture built not on metal, but on promises. This empire was headquartered on a single exchange in the United States. COMEX, the commodity exchange in New York. COMEX was never designed to reflect the physical world. It was designed to price it. And for decades, bankers discovered something extraordinary. You don't need metal to control a metal market. You just need contracts. A futures contract is supposed to represent silver, but on COMEX, one physical ounce can be multiplied 100 times, 200 times, sometimes more. One bar in a vault becomes a stack of digital claims, a tower of obligations that expands far beyond the real-world supply. This is how the paper empire worked. If physical silver was scarce, print more contracts. If investors bought too much, print more contracts. If industrial demand surged, flood the market with paper until price pressure disappeared. For every ounce that existed, hundreds of ounces were traded. That ratio, sometimes 200 to 1, wasn't a flaw. It was the design. Because silver is heavy. Silver is expensive to store. Silver requires vaults, insurance, audits. But paper is cheap. Paper is instant. Paper can be created at the speed of a keyboard. Banks didn't want metal. Metal ties up capital. Metal has to be delivered. Metal exposes the truth. But derivatives? Derivatives can be expanded infinitely and controlled. That's how the ceiling at $50 stayed intact for decades. Not because the market wanted it, but because the paper empire defended it. And they had many tools. Tool 1. Margin hikes. If silver started to rise too fast, exchanges increased collateral requirements, forcing weak hands to sell. Tool 2. Spoofing. Traders placed enormous fake orders to intimidate markets and push prices down, a practice so common that federal prosecutors eventually charged multiple banks for it. Tool 3. Media control. Every surge in silver was labeled speculative, irrational, unsustainable, convincing the public the metal had no real value. The system was brilliant, cold, efficient, elegant, and it relied on one critical assumption: that physical silver would always be available. As long as the vaults had metal, the paper could outrun reality. As long as stockpiles existed, futures markets could pretend supply was infinite. As long as the ghost inventory stayed full, the empire could defend its price ceiling. But the moment physical supply tightens, everything breaks. Because futures contracts only work if someone, somewhere, can deliver real metal when required. If the world has enough silver, paper controls physical. If the world runs out of silver, physical destroys paper. That moment arrived quietly in late 2024. Vaults fell toward minimum operating thresholds. Lease rates spiked. Delivery requests slowed, not because people didn't want metal, but because metal wasn't there. Behind closed doors, banks began to panic. Not publicly, never publicly, but privately, they understood the danger. You cannot sell a claim on metal that doesn't exist. You cannot suppress a price when the physical world calls your bluff. You cannot maintain a paper empire when the foundation, the metal itself, has disappeared. And so, in 2025, when the deficit widened and the ghost inventory hit zero, The paper machine finally stalled. Contracts kept trading. Charts kept flashing. Analysts kept talking. But the illusion was gone. The banks could multiply paper. They could manipulate sentiment. They could flood the market with contracts. But they could not print silver. And so the empire cracked, not with an explosion, but with silence. A silence that spread across trading desks as analysts stared at delivery reports and realized what it meant. For the first time in modern financial history, the physical market had severed its leash, and the paper empire failed the moment the physical ran out. While Wall Street was busy defending a price ceiling, another part of the world was quietly preparing for the moment the ceiling would break. Not the United States, not Europe, but the East. And their strategy didn't involve derivatives, leverage, or high-frequency trading. It involved something far simpler and far more powerful. They bought the metal, the real metal, and they bought it cheaply while the West was distracted. To understand how the silver market flipped in 2025, you must understand the role of two nations, India and China, the largest physical consumers on Earth. And it begins with a month that shocked even the insiders. February 2024, a month that will be studied in financial textbooks for decades. That month, India imported over 2,295 metric tons of silver, a staggering 73 million ounces. To put that in perspective, that's more silver than the entire U.S. Mint produces in 3 years. That's more than most Western vaults move in half a decade. That's enough metal to drain a major exchange of its registered supply. And India did it in 28 days. Why? Not speculation, not panic, not hype. It was culture and industry, two forces the West consistently underestimates. In India, silver is not a trade. Silver is tradition. It is savings, inheritance, dowry, religious offering, and generational wealth. Families don't buy silver for a month. They buy it for a lifetime. When prices were manipulated low, India didn't complain. India accumulated. But this time, something else was happening. Something new, something strategic. India wasn't just buying jewelry-grade metal. It was buying industrial-grade silver paste. Its factories were scaling up solar cell production faster than any nation on Earth. Its electronics sector was expanding. Its bullion market had regained momentum after a decade of underinvestment. India wasn't responding to price. India was responding to reality. It saw the deficit forming before the West did. It saw the solar vortex coming before analysts modeled it. It saw the LBMA inventories shrinking while European investors were selling their ETFs. And so India did what smart nations do. It bought the bottom. China followed a different path, quieter, more systematic, more surgical. China didn't import record volumes the way India did. Instead, China was drawing down its own stockpiles while ramping up industrial consumption. Its solar manufacturing base was already the largest in the world, and it needed more metal every quarter. China wasn't hoarding silver. China was using it, transforming it into panels, batteries, semiconductors, and military technology products that generate economic and strategic power. While Western investors debated whether silver was too volatile, China absorbed the metal and turned it into infrastructure. While Western banks dismissed silver as an outdated commodity, China embedded it into the technologies that will define the next century. And while Western traders treated silver as a chart pattern, China treated it as a strategic resource. It was a quiet transfer, not through manipulation, but through opportunity. From 2021 to 2025, Western investors sold tens of millions of ounces through ETFs, trusting digital claims over physical metal. They believed the markets were fair. They believed price reflected supply. They believed silver was abundant. But the East didn't believe. The East observed. The East calculated, and the East acted. The result? By the time silver crossed $59, the West had offloaded massive quantities of metal, and the East owned it, not on paper, not in futures, but in vaults, factories, and supply chains. This is the part of the story that Americans rarely hear. While the West was playing the financial game, the East was playing the physical one. And in a market where the world is running out of metal, only one of those strategies survives. The West played the financial game. The East played the physical one. To understand why silver's price stopped obeying gravity, you have to leave Wall Street, leave the vaults, leave the trading desks, leave the banks, and go somewhere completely different, a solar factory. Because silver's story is no longer a financial story. It has become a technological one. For a decade, the world believed solar panels were becoming cheaper and more efficient because of innovation alone. But behind the scenes, a material war was unfolding, a war that silver quietly won. Phase 1, the PERC era. For years, PERC solar cells dominated the industry. They were simple, reliable, and required only about 10 milligrams of silver per watt. A manageable load, a stable demand. But PERC had a ceiling. It could not get any more efficient. It had reached the limits of what was physically possible. And in the energy world, efficiency is everything. Because when you're building gigawatt-scale solar farms, even a 1% improvement changes the economics of nations. So, the industry began to pivot. Phase 2. TOPCon takes over. By 2023, 2024, manufacturers around the world, especially in China, transitioned from PERC to TOPCon. TOPCon wasn't a small upgrade. It was a leap. Better performance, better longevity, better output in low-light conditions. But TOPCon came with a hidden cost. It didn't use 10 milligrams of silver per watt. It used 13, a 30% increase in silver consumption, multiplied across hundreds of millions of panels. And before the world could stabilize around TOPCon, another technology appeared. One even more silver-hungry. Phase 3. The rise of HJT. Heterojunction cells, HJT, represent the cutting edge of solar engineering. They are incredibly efficient, incredibly durable, and incredibly dependent on silver. HJT doesn't use 10 milligrams. It doesn't use 13. It uses 22 milligrams of silver per watt, more than double the PERC era. The world wasn't moving away from silver. It was becoming addicted to it. And here is the twist most financial analysts still do not understand. You cannot build a solar cell without silver. There is no substitute. And they tried. Why not copper? On paper, copper looks perfect, cheap, abundant, conductive. But there's a problem. Copper oxidizes. It corrodes. It breaks down in ways that destroy a panel long before its 25-year warranty is up. Solar manufacturers tested copper pastes for years. They ran trials. They pushed material science to the limit. And the verdict was clear. Copper works in a lab. It fails in the real world. A solar farm cannot risk billions of dollars on a metal that rusts. Governments cannot meet climate goals using panels that die a decade early. Investors cannot finance infrastructure built on unreliable materials. So they stick with silver. Not because they want to, but because they have no choice. And this is where the economics becomes something entirely new. Inelastic demand. In most markets, when prices rise, demand falls. Consumers pull back. Industries slow down. The market adjusts. But the solar industry is not optional. It is mandated, financed, subsidized, locked into national energy strategies. If silver rises from $25 to $50, solar manufacturers keep buying. If it rises from $50 to $80, they still keep buying. Because the silver inside a panel might cost $15 at old prices and $30 at new prices, but the entire panel costs $200 to make. Silver doubling in price does not double the cost of the panel. It increases it by only 10%. That means demand does not respond to price. It ignores price. It overwhelms price. It becomes inelastic. So when the deficit widened, when ghost inventory vanished, when vaults hit historic lows, the industrial world didn't slow down. It sped up. Solar factories called refiners. Refiners called wholesalers. Wholesalers called miners. And every call ended with the same message. We will take whatever you have, and we will pay whatever we must. This wasn't investor demand. It wasn't speculation. It wasn't hype. It was survival. A global industry facing a raw material that suddenly behaved like a precious metal because it was one. And the financial world, still clinging to its paper models, didn't understand what was coming next. Because when industries cannot stop buying, when nations cannot delay energy transitions, when demand becomes untouchable, a vortex forms, an industrial vortex. What happens when industries must buy at any price? For years, the industrial world operated on a simple belief. Silver may be tight, but it will always be available. There will always be another shipment, another seller, another vault, another stockpile somewhere in London or New York. But in late 2025, that belief collapsed quietly, then violently. The first signs came from inside boardrooms, not markets. CFOs of major electronics firms, solar manufacturers, and battery producers began receiving reports that didn't make sense. Delivery delay, 4 weeks. Shipment reduced by 40%. Refiner unable to meet contract volume. Spot premiums elevated beyond acceptable range. This wasn't a pricing issue, this was a supply issue. And when supply becomes uncertain, something predictable happens. Companies stop using just-in-time inventory. They switch to something far more desperate, far more disruptive, far more dangerous. They begin hoarding. Phase 1, the quiet hoarding. Tesla increases its silver purchase orders not twice, but 3 times in a quarter. Not because it needs the metal now, but because it fears needing it later. Samsung sends representatives to refiners, negotiating not contracts, but exclusivity. Reserve future output for us. Name your number. Solar megafactories begin buying ahead for an entire year's production cycle. Gigawatts of capacity locked in with physical commitments. None of this appears in public markets. The price charts don't show it. Analysts don't talk about it. But in the physical supply chain, stress spreads like cracks through concrete. Phase 2, the private vault surge. Meanwhile, private vaults experience an event nobody predicted. Demand skyrockets. Phone calls pour in from family offices, pension funds, and high net worth investors, not asking for futures, not asking for ETFs, but for bars. Real bars. Delivered, allocated, segregated, untouchable. Vault managers in Singapore, Zurich, and Dubai report the same phenomenon. Clients don't want exposure, they want metal. Phase 3, the Great Western Exit. As individuals and industries rush for physical silver, another shift unfolds. Western investors begin selling their ETFs. SLV, PSLV, European silver funds all see steady outflows. Analysts misinterpret this as lack of interest, but they don't understand what's happening. Western paper silver is being sold, so Eastern buyers can take the metal. Every Western outflow becomes an Asian inflow. Bars that sat in London vaults for years are packed, shipped, and permanently removed from the global float, melted into industrial paste, turned into jewelry, or stored privately. What leaves the West does not return. Phase 4, the mining bottleneck. With demand surging from every direction, attention turns to the miners. But miners cannot respond. Not in months, not even in years. A new silver mine takes 7 to 10 years to bring online. Existing mines are declining in grade. Labor shortages persist. Environmental permits delay expansions. And many primary deposits are already exhausted. The world suddenly realizes something stunning. You cannot print silver. You cannot synthesize silver. You cannot accelerate geology. The supply is fixed in the short term, painfully fixed. The moment the system breaks. By late 2025, the panic becomes visible. Premiums detach from spot price. Delivery times stretch from weeks to months. Industrial buyers start offering above-market rates just to secure shipments. The futures market still shows normalcy, but the physical world looks like a bank run in slow motion. And then, quietly, almost politely, a global scramble begins. Not the kind that makes headlines, not the kind that sparks fear, but the kind that happens behind closed doors, in factories, in vaults, in procurement offices, in negotiation rooms, a scramble where the question is no longer, how much does silver cost? But instead, do you have any? And most suppliers answer the same way, no, but we can put you on a list, a waiting list, for a metal the world always assumed was abundant. The scramble for silver had begun quietly at first. When silver finally crossed $59, most analysts focused on the number, but the number wasn't the story. The real story was the space above it, a space that had not existed for over 4 decades. Economists have a name for this kind of moment. They call it a blue sky breakout, a point where an asset escapes its historical boundaries and rises into territory with no reference points, no ceilings, no sellers, no memory. Most assets never experience it. Silver did. And the reason is simple. There was no overhead supply. No long-term investors sitting on massive positions waiting to get out at break-even. No old bag holders waiting to dump their metal at $60 or $70. No stack of sell orders layered above the price. Why? Because silver had been suppressed for so long that almost nobody in the modern market had ever bought at those levels. In Bitcoin, it happened when the price blasted through $20,000. In Nvidia, when it crossed $200 and the chart turned vertical. When an asset breaks its all-time range, price becomes air, and air does not resist. Silver entered that same territory in 2025. For 40 years, the $50 line acted like reinforced concrete. Banks defended it, media justified it, paper markets enforced it. Every spike was hammered back down. But once the physical market forced silver above that line, once reality replaced illusion, the entire structure flipped. The ceiling became the floor, and above that floor, nothing. A vacuum. A space where price could only be discovered upward. Most people misunderstand what a vacuum means in financial markets. They imagine chaos, volatility, speculation. But a vacuum is simpler. It means that the only way to find a seller is to keep raising the price. In late 2025, that's exactly what happened. Spot buyers chased refinery output. Industrial firms chased spot buyers. Investors chased industrial firms. And all of them were bidding into empty space. Charts stopped behaving rationally. Historical models broke. Analysts on business television began wearing the same confused expression. The expression of someone who realizes their tools no longer work. Because price is predictable when supply is known. But what happens when supply is unknown? When the market realizes there is no hidden inventory, no emergency reserve, no strategic buffer, price does not move gradually. Price lunges. The last time this dynamic appeared was the 1980 bull run, when silver escaped financial gravity and no one could calculate fair value. But even that event was driven by speculation. This time, the engine was physical shortage. That's the difference. And that's why the charts look different. Every technical indicator said overbought. Every textbook said pullback. Every analyst said unsustainable. But the market said something else. You can't call something expensive when you don't know how much exists. When silver passed $60, the traders who once defended the ceiling stepped back. The banks that once sold paper contracts stopped shorting. The algorithms that once stabilized, the price switched off. Because you cannot suppress a market that has slipped its cage. This is the moment markets fear, and the moment long-time silver holders dream about. True price discovery. A rare, dangerous, liberating phenomenon where the market finally asks, what is silver actually worth, without manipulation? And the early answer, whispered into the order books, was unnerving. Not $59, not $60, not even $70, but something higher, something entirely unfamiliar, something the charts had never seen. Because once silver cleared its manipulated ceiling, once the physical market proved the paper market powerless, the free market took over. And the free market was not gentle. When silver crossed $59 and kept climbing, most people saw a commodity spike, a chart going vertical, a market breaking out. But that view was too small, too narrow, too comfortable. Because what happened in late 2025 was not just a price move. It was something far more profound, something that shook the foundations of global finance. It was the moment reality began to reprice itself. 1. The dollar felt the pressure. For decades, the strength of the US dollar rested on a simple assumption. Raw materials would always remain cheap and available. Oil, copper, lithium, silver. But when silver surged, a metal essential to energy, technology, and defense, the world took notice. Foreign central banks began asking a question they had not asked since the 1970s. If key commodities are rising because the world is running out, what does that mean for the dollar? A currency backed by paper is stable until the real world pushes back. And in 2025, it pushed hard. The rising cost of silver signaled something larger. America's energy transition was about to get far more expensive. 2. The energy transition bill exploded. Every solar panel, every EV battery, every data center cooling system, every semiconductor line, they all needed silver. And when silver doubled, tripled, or worse, the cost of building the future doubled with it. States revising renewable energy budgets suddenly discovered billion-dollar holes. Corporations bidding on solar farms were forced to renegotiate contracts. Startups building green technologies found themselves unable to secure materials at any price. The United States had spent decades planning an energy revolution, without planning for the metal that powered it. And the bill finally arrived. 3. geopolitical tensions rose quietly but sharply. Meanwhile, countries that once cooperated on resource sharing began to pull back. Indonesia restricted nickel exports. Chile debated nationalizing lithium. Mexico tightened control over silver-rich territories. China prioritized domestic consumption over global supply. A new form of nationalism was emerging, resource nationalism, and for the first time in decades, silver was not just a commodity, it was a strategic asset, a metal that could strengthen nations, or weaken them. 4. Miners became power brokers. For most of modern history, mining companies were treated as old-world businesses, slow, risky, uninteresting. But when the shortage became undeniable, everything changed. Suddenly, mining CEOs were invited to government summits. Hedge funds fought for positions in major mining firms. Private equity began acquiring exploration companies. Nations scrambled to secure long-term supply contracts. Miners were no longer at the edge of the financial system. They were at the center, and markets that once ignored them now watched their every move, every drill result, every production forecast, every political risk, because the world had rediscovered a forgotten truth. You cannot build a technological civilization without the metals that hold it together. 5. Financial markets entered panic mode. As the physical shortage became visible, financial markets reacted with fear, not greed. Options markets widened. Volatility spiked. Liquidity thinned. Short sellers retreated. Commodity desks scrambled to rewrite risk models. Investors began asking questions no one wanted to answer. If silver is short, what else is short? Are the reported reserves real? What other markets depend on ghost inventories? The panic was subtle, but deep. A realization that the global economy had been built on assumptions that no longer held. Silver was simply the first crack in the facade, the larger truth. This wasn't a speculative bubble. It wasn't a meme trade. It wasn't a Reddit movement. It was the physical world forcing the financial world to tell the truth. A truth about supply. A truth about demand. A truth about the limits of the planet itself. And as the charts climbed higher, as vaults emptied, as governments recalculated their energy plans, one realization spread from trading floors to boardrooms. This wasn't a price surge. It was the repricing of reality. For 40 years, the world believed silver was abundant. For 40 years, analysts, bankers, and policymakers treated it as just another industrial input. Cheap, stable, endless. But as 2025 came to a close, that belief collapsed. Because the world hadn't run out of silver. It had run out of cheap silver. The kind that was easy to mine, easy to lease, easy to manipulate. The kind that allowed the financial system to pretend scarcity didn't exist. For years, the math was right in front of us. The deficits, the shrinking inventories, the offtake from solar and electronics, the Asia-bound shipments that drained the West ounce by ounce. But like all uncomfortable truths, it was easier to ignore, easier to believe the old models, easier to trust the paper market instead of the physical one. Until one day, the numbers caught up. The 1.1 billion ounces didn't disappear. They were consumed, absorbed, locked away, asterisk, asterisk. The silver that vanished wasn't a mystery. It flowed into solar farms across the deserts. It disappeared into smartphones and satellites. It was melted into jewelry in Mumbai and tucked into vaults in private homes. Some of it was buried in landfills, never to be recovered. For 5 consecutive years, the world used more silver than it produced. 5 years of deficits that everyone saw and no one acted on. That is how you erase 1 billion ounces without a sound. Not overnight, but day by day, month by month, until the inventory that propped up the system simply evaporated. A decade of deficits finally surfaced. For most markets, shortages are visible the moment they happen, but silver is different. It has always been a shadow market, a market where old stockpiles hid new problems. For over a decade, the numbers whispered a warning. In 2021, softness turned into deficit. In 2022 and 2023, deficit became drain. By 2024, vaults that once held oceans of metal had receded to puddles. And by 2025, the global system reached a point it had avoided for almost half a century. True price discovery. A moment where supply and demand, not banks, not derivatives, not algorithms, determine value. Price discovery is not a spike. It's the return of truth, asterisk, asterisk. For decades, silver's price wasn't false. It was incomplete. A number shaped by assumptions. A number held down by inventory that no longer existed. A number disconnected from the physical world. When the breakout came, it didn't represent greed. It represented clarity. The market wasn't exploding. It was correcting. Correcting for years of underinvestment. Correcting for industrial overconsumption. Correcting for a global energy transition built on unrealistic cost models. Correcting for a West that sold too much, too cheaply, for too long. Price discovery is what happens when illusion loses its footing. And in 2025, the moment the paper system lost its buffer, the illusion finally fell. For years, people asked, what will it take for silver to move? What will trigger the breakout? What event will finally expose the truth? In the end, it wasn't a headline. It wasn't a scandal. It wasn't a whistleblower. It was the math. Steady, relentless, unforgiving. Because markets do not break when prices rise. Markets break when truth returns. Closing line, signature. The market didn't break. The illusion did. If you'd like more long-form financial storytelling, deep dives, narrative breakdowns, and economic explainers the mainstream won't touch, feel free to subscribe.